ladies and gentlemen. Welcome to another episode of the Mindful Investor Podcast Show. I'm your host, Steve Rosenberg, and I'm the head of investor education at Mynd Property Management. And the whole reason we created this show is not just to take the perspective of property managers, but also to talk to investors and see all the different facets of what goes on in the investing world. And anyone who's been in the investing world long enough knows that there is probably millions of ways to not only make money, but lose money. And unfortunately, I've been on both sides of that pendulum many times, but I have learned as I kind of go deeper into the investing world is that there's so many different layers of information and data and things that you can extrapolate out from the investing world. It just never ceases to amaze me. And I get the opportunity to talk with so many people that have such different revenue streams that kind of make this whole thing go around that you would never even think would be not only just a business, but a huge revenue generating business of all kinds. And it could be from self-storage to multifamily to purchasing assets and not just in this country, but in all over the world. And the guest I have on today, we're going to talk about what he does and how he has not only solidified his position in this industry, but has made it a huge revenue generator for him and his company. Jim, I'm going to do my best to get this. So if I butcher it, tell me if I got it wrong, but Jim Maffuccio, how's that? How'd I do?
That's perfect, man. You even did it with the little Italian accent there, so.
I even had my hand up a little bit when I said it. So Jim is with Aspen Funds and they deal in notes. And I think it's so interesting. I've done a little bit in this industry, just really touched my toe in the water, if you will, of this industry. And I know it is a huge model. And I'm curious if it's going to get bigger or shrink in what's coming in the industry. So first of all, Jim, thank you so much for being on the show with me today. I appreciate it.
Hey, thanks for having me, Steve. It's a pleasure and honor to be here with you.
So tell us a little bit kind of about Aspen Funds and what you do. And more importantly, how did you get into this world of buying notes?
Yeah, how did I get into this anyway? So,
you say that every day?
Actually, I mean, I've just been having the time of my life. It's been a great ride with Aspen. So what Aspen Funds is, we're a fund management company, and we actually run various mortgage funds, and we have two sides of our business. One side is the distressed side, where we actually purchase non-performing mortgages. And then we have a whole team that does workouts with the borrowers. Our main goal there, our objective, is to create a win-win situation. We're buying these loans from institutions for, at a deep discount, let's just say that. And then we're also creating a situation for homeowners where the vast majority of the time they're able to stay in their home at a lower payment, an affordable payment, have some equity in their property, and then of course we're serving our investors and generating some great returns, great secured returns for them. And then we have an income side of our business where we buy reperforming and performing mortgages, and it's really just a cash flow play, because there's a lot of investors out there that are trying to figure out a way to get some decent cash flow and secure cash flow. So we have the core competencies of being able to fix loans when they break. So we buy loans that a lot of institutions maybe wouldn't buy, but they have typically plenty of equity. So we're able to just they're high touch, but we like doing that. We like touching them and fixing them and working with borrowers and keeping everybody on track. So it's been, honestly, it started. I started this as my beta test was me and my son in the basement of our home in Kansas City. And I bought my first notes in 2011, and they were non-performing second mortgages behind performing first mortgages. And, really saw early on that, man, I can make fantastic returns on these if I can get them worked out. And then, beta test was a success. And so my next step was to go start raising money to do this thing. And I ran into a guy who's now my business partner. We had a kind of a casual friendship. Knew of each other, and we had coffee one day, and he asked me what I did, and I explained it to him, and he thought I was insane. And then I said, well, let me put it on paper for you and show you how this works. And he about flipped. And he's a gentleman that was a tech guy. He had started a tech company in the mid 90s, actually the fastest growing company in the Midwest at the time, tech company. And so anyway, he said, well, hey, I'm looking for my next rodeo, and why don't we partner up? I'll go raise capital and do all the business financial side of the business, the back side, and you just go do deals. And I said, hey, man, that works for me. So we started in 2012, and now we have 25 employees, and I think we're on our sixth fund. And we actually made the Inc. 5000 fastest growing privately held companies. And, so honestly, it's been phenomenal for the last, 8 years in this thing. So
that's great. Now if we can put this in third grader terms. Now I've had
perfect.
Notes before.
That's perfect for me.
Exactly. So I've had notes before that I've owner financed, and then I've had people come and purchase them at a discount. So I understand at probably a micro level of what you do. I've done that several times, and I understand the value. Can you explain to the guests, first of all, why would a bank, because I'm sure they're saying, why would a bank want to sell a note, right? Because you're buying it at a discount. I'm assuming, unless I have this wrong. Why can you explain why does this make sense for a bank to shed that debt, and why does it make sense for you to buy it?
Yeah, well, it makes sense for a bank to shed the debt because at the time, when a lot of this debt was bad debt was created, let's just say, when it started going bad, these institutions have to get non-performing debt off their books, or their reserves requirements shrink or increase tremendously, and they go out of business. They're highly regulated. So
right.
So that's when I saw this model. Just to give you a really quick background, I've been full-time employed as a real estate entrepreneur, self-employed as a real estate entrepreneur since 1986. So mostly as a small developer in Southern California of residential properties. And I've gotten my butt handed to me twice. And it's both times it was because of the mortgage financing situation. The most recent being the 2000, the mortgage crisis of 2008, we call it. Mm-hmm. So I knew a little bit about debt and how it can work against you. And I realized that, debt kind of makes the real estate world go around. But I saw this, I'm sitting in 2010, broke. I got zero. I've got 5 teenagers. I'm in my mid 50s. And it's like, okay, I got to take the raw knowledge that I've accumulated over 30 years and figure out a way to retool myself and get back on a winning track here. And, I quickly realized that, every single one of these loans that where the people stop paying, this is an asset that this bank has to get off their books. Absolutely has to get off their books. So, some cases they foreclose, and then of course everybody's buying the REOs and fix and flipping them. And I did some of that, but I started looking upstream and saying, well, what if I could get to these assets before they become an REO for the bank? Because banks can't afford to take on that much REO, or they go out of business. So right. This is a real super simplistic terms, but I realized that this is where the money's going to be and the opportunity is going to be. So I went to my first conference in 2010 in Denver and listened to some guys that have been in the debt space talk about how they're buying these non-performing mortgages for, at a high discount, and then doing workouts with the borrowers and creating a profit because they're turning a non-performing asset into a re-performing asset. And so to answer your question, the institutions will discount these things as much as they have to get it sold and get it off their books. Now, I decided to jump in going after defaulted second mortgages, which obviously scares the heck out of most people. And these are at the bottom of the totem pole for the institutional lenders. They're treated differently. They charge them off after 90 days, and they pretty much go in the dirty underwear drawer, never to be, right. See the light of day. So we buy these at a really deep discount. And anyway, there's dynamics involved that allow us to make really nice multiples for our investors, and again, keep people in the homes with an affordable payment. So.
And so and maybe you can kind of shed some light on this. From what I remember when I learned about this, is that banks have to keep, I believe it was like 4 times the amount or something, 4 to 8 times the amount in reserve of the note that they have. There's a multiplier, right? And maybe it changes.
Yeah. There's a multiplier, and it's based on a risk evaluation of their whole portfolio, how much of it's performing, how much of it's subperforming, how much is what they would call scratch and dent, and then how much of it's in default or in accrual. And yeah, they have to manage that portfolio, because for the loans that are perfectly performing, there's a lot lower of a reserve requirement. But when their loans start breaking, the reserves that they're required to keep on their books go through the roof. And if they don't have those reserves, they're out of compliance, and they can get shut down. And that's why you had all of these institutions get gobbled up, and some of them went south during the mortgage crisis.
Just like we have credit scores, banks have credit scores, and their lending institutions are, their requirements to hold reserves are just as much. So let me ask you this, Jim. You had mentioned the 2008 recession, which I very clearly remember. And, I've always believed and been taught that real estate is in cycles. And normally I've been taught it's about a 7-year cycle. Maybe, I'm sure everyone has a different opinion. But it's, we had the 2008, then we kind of went into the 2014 with high oil. This is in Houston, at least in Texas. And now we're in 2020. So it's about another 6-7 years. Do you see any remnants of the industry, of the mortgage industry, replicating what you saw maybe in 2008 when you were on the other side of it? But do you see any rippling effects, reminiscent of that?
You mean, do I see another situation like that occurring?
Yeah.
I hate to be the guy that says it's different this time. You've probably heard that phrase. It's what us real estate guys tell ourselves to keep us sane, whenever there's whenever there's trouble brewing. But honestly, the amount of equity that people have in their properties today, the loans that have been created post 2010 or 11 are really, they really were underwritten better. And so we don't really have a lot of really bad paper out there. So the dynamics that created that blow up, that train wreck in that, if you saw the movie The Big Short, where, I mean, there's so much truth in that movie. I mean, you could get a loan if you could fog a mirror, and then you could go get 5 more loans, and
Right.
So that was a bug looking for a windshield in every sense of the word. So I don't see that now. I mean, if you look at the big picture, we are extremely underbuilt as a nation in real estate, and the markets that people are moving to, you can't build houses fast enough to keep people, sheltered. So we're making people faster than we're making houses, and so if you just do the simple supply demand equation there. Now, are there sub-markets in specific locales that can get overheated and where things are overpriced? Absolutely. We're not afraid of the coast, but we've been trying to kind of, our portfolio is pretty much diversified geographically. We love the Midwest. We love the boring middle, the flyover country where, real working people that, the only way they're not going to pay their mortgage is if they absolutely lose their job and can't get reemployed. And that's just not the reality of our economy right now. So I don't see any bubbles there, and especially with today's interest rates. So not to say something couldn't happen, there couldn't be some correct. COVID has certainly caused a little a wave of drama to come into the system. There's some people that are going to, it's, I hate to say it, it's kind of like the physical body. It's like people that were maybe hanging by a string to begin with, or maybe were in a little bit over their head. That event is going to be enough to take them out, which basically means they just got to maybe downsize and find another place to live. But I don't see it, Steve. I think real estate in general is a great investment, for the foreseeable future. So.
Well, and I think that what we saw back in 2008, that was systemic, right? We caused that to happen in general.
Absolutely.
This, I don't think, is systemic. I think we'll see there will be a correction. I don't think it'll be as spectacular and as large scale as what we saw. So, look, since if you study real estate, there's always market corrections and cycles.
That's right.
They're not all this grand, like we saw in 2008 or even after 9/11. There are always going to be corrections. It's never static. And I think that, to me, a perfect example was, and I'm curious if you have noticed it on your side, but the short-term rental industry. I think that while it's, it kind of has corrected, I think it also showed a bit of a kryptonite where maybe they need to look at maybe having another exit strategy or something else. So it showed a weakness in the model, and some people that, kind of were a little sloppy and lazy with their numbers probably got corrected and maybe are no longer in that world anymore because they couldn't afford it. But I think all in all, the nucleus of it is solid. Are you seeing anything from that regard? Like, are you seeing a certain industry starting to spit off more distressed notes than another?
Yeah, well, not so much seeing it on a personal level. I mean, I read a lot. I keep up with newsletters and different feeds. And in our business, we're not seeing it because, again, we're focused on, residential. Most of our paper is secured by workforce housing. And honestly, we just didn't have much drama. We didn't have a lot of defaults. We didn't even have a lot of people asking for forbearance. You brought up the short-term rental deal. I mean, I really had my eyes on that because right from the beginning, I thought, wow, I'm going to go pick up a couple condos up in Breckenridge because there's going to be people that are counting on that, that short-term rental income coming. And, if they're over leveraged, that market has done nothing but go up. We just didn't see it. We didn't see all this distress. If anything, I think it created a better opportunity for short-term rental players because if you're in these areas that are accessible to a large metropolitan area, then you had people that instead of going on the vacation they might have gone on, a year pre-COVID, now they're like, hey, why don't we just go get an Airbnb and go hang out in the mountains and get away from the crowds? And so really it's now the one area where I do think this isn't so much a cyclical thing, but it's kind of a paradigm shift. And I mean, here, look at us both. We're sitting here, I got all my cluttered stuff in the back behind me. I've worked out of my home since 1986, so it's not a big deal to me, but we closed down our office. We have 6 employees in Maryland that, we had an office out there and, they all had to go home because of COVID. And, they made the adjustment really, stellar the way they adjusted to it. And me and my business partner, we interviewed each one of them and said, well, what do you think about returning to the office? And are you anxious to do that? And they all started talking about, well, really, it's a 45-minute drive. It's East Coast drive. It's really working from home. And, the bottom line is, Steve, we let the office go. Our lease was up in October and we said, the heck with it. We don't need an office out there. And it was an aha moment for me because I realized, we're a small company and we're discovering this. I think employers are discovering this across the country. I think there's going to be a bunch of office space that's not going to be refilled. And so there's going to be a repurposing of that space. I think there's going to be a lot of even retail space that's going to be repurposed. So I do think there's some big sea change type things that will happen as a result of COVID, but not the cyclical stuff. It's not, So anyway, if that makes sense, I always look for opportunity. I'm always looking for opportunity. So,
well, it's interesting you say that because my next question, I had a gentleman on the podcast show. He was a real estate attorney in the Bay Area. And we got into the discussion of, I had a question. I said, let's talk about some of the tech companies there, the Googles, the Netflix, whatever. And now they're saying, okay, you don't need to live here anymore. And you could still work here, just like you said, and you can move back to Tulsa, Oklahoma, or Monument, Colorado, wherever you want to live, and you can live with family, but they're still employing that person. So now that revenue is now not going back into the city of San Francisco. It's now going to Tulsa, Oklahoma.
Hello.
And the person that was renting the 3-bedroom studio, or I'm sorry, $3,000 a month studio in the Bay Area is no longer renting it. So my question is who rents that now? And is that the next downturn that's going to happen?
Yeah. I think you nailed this is something again that it's been one of those little areas of study for me. And ever since I moved from Southern California to Kansas City, and my eyes were really open to, it's just a different way of looking at real estate, and I the quality of life where we lived, I loved it. And here in Monument, I feel like I'm in heaven. And you mentioned Tulsa, Oklahoma. Well, what happens is when these young people, get over their California thing,
right,
and they move to a community like that, and they realize, man, instead of renting and sharing a place for $3,000 a month, I can buy a home where my mortgage payment is, $1,200. And I mean, that's a castle in Tulsa or Kansas City, or, so many other of the the heartland markets, and the quality of life is phenomenal. I mean, there's sports teams, there's cities, there's, it's so, yeah, you don't have the ocean view, but, and you live in a place like Colorado, you have the mountains to run to. So I think there's going to be a big exodus of people from those coastal, high pressure, kind of fast moving, squeeze the last dime out of your markets into these more, Americana type places.
Well, and I think that the main point here is they still have their jobs.
Absolutely.
Their jobs on the West Coast and wherever, even the East Coast, they still are getting that revenue. So the companies are not missing a beat. The one who's missing a beat are, the landlords, as you said, and the commercial owners. Now,
that's right.
For you as someone who buys distressed notes, do you look at that and say, not sure that that's something that I want to go into? Or do you, when you're looking at a note, I guess my question is are you looking at what your exit strategy is on the note and thinking this could be too dangerous, like commercial or these high-end residentials that you may not see the exit?
Yeah, well, first of all, our business model right now is laser focused, and the models that we build our funds around are very narrow focused because we're very good at, be really good at one thing, and then if you want to add other things later. So we're in the on our non-performing side, we buy non-performing second mortgages, period. And we've done thousands of them, and we know what our multiples are going to be. We know what our exits are going to be. Not on an individual note basis. We don't know how that specific note's going to exit, but there's, we start going down the road in the logic diagram. Now, as far as looking at other pursuits, like other types of debt, yeah, absolutely. I'm interested in, I'm definitely interested in the commercial debt. I think it's going to be more of a question of networking with commercial developers and commercial entrepreneurs. And I obviously want to get a handle on what are some of these repurposings that you can do with properties. But I mean, obviously, if there's a distressed note on an apartment building, well, you're not going to convert the apartments to anything. You might change, you might do a value add play. But on the other hand, if there's a failed, shopping mall, there's people turning those into storage, and flex space and things like that. So that's kind of a one-off deal. You find a deal here and a deal there. So I don't think it scales as well for us when every asset you buy is a project in and of itself. But there's ways of doing it. There's ways of working that. We just haven't stepped into it yet. But I'm watching it, Steve. I'm keeping an eye on those kind of opportunities. So I don't know if that answers your question.
No, it does. It does. Now, if I was obviously, if I'm not a Jim and I don't have an Aspen Funds and I'm watching this show and I'm thinking, how do I even get into this world? Because I know some people obviously on a much smaller scale that do this. What are some things that someone, if they want to even learn a little bit more about this and understand it, how does someone educate themselves in this?
Okay. Well, first of all, you can't get any smaller scale than where I started 8 years ago in this. I hope that's meant to be an encouragement. I mean,
yeah.
It was literally me and my son and buying 3 notes for an average of about $4,000 each, guys. So, I mean, and that money was raised from outside because I didn't have the $12,000 to buy them with. So I literally was zero in 2010 and even in 11. And then in 12, I started gaining traction. So, and what I did and built the whole company based on initially was conferences. And so obviously right now conferences are virtual, and I like the real one. I like the live ones better because I like hanging out with people and getting to know people. But there is so much information out there. And if people want to visit our website, we don't do training or educating, but I can point people to people that actually do, that I trust, that I know and trust in the industry. But there's some really good conferences. There's some really good mentors out there. And you really just start learning it. You start reading their stuff. You start joining the groups online and going to watch their YouTube channels, and you can get up to speed. Anybody that's been in and around real estate to make the transition over to the debt side, you already know way more than you think you do already about mortgage debt because you've had to apply for a bunch of it. So if you really just kind of put yourself in the position of the lender, that's all you're doing. So there's great resources for a person to get involved, either buying one note at a time or wholesaling and brokering notes between buyers and sellers, or raising funds and becoming your own, do what we're doing. So it's out there.
Yeah, I think that, at the end of the day, you have to be able to solve a problem. And I think at the end, you've got to, is there a problem in this industry? I think inevitably, yes, there is a challenge that you
Yeah,
can solve. So you have to sit there and ask, okay, how do you solve that problem? That's the basic sales concept of anything.
that's
And I,
right.
so I think the answer is yes, you definitely can, but you've got to go in with the knowledge. And that's why I think it's smart, like you're saying, go in, educate yourself, go online, learn all this stuff so that you can know what you're doing. You can create your business model with you got to get the front and the back end done before you actually start business, in my opinion, to
That's so right.
have a successful outcome.
Yeah. It's so, and I'll say this too. It's so much a relationship business. I mean,
Yeah.
we do people, I met people, the very first conference I went to, two of them ended up coming to work for me once I, partnered up with my partner and we started raising some decent money and could start paying people. And so, I mean, I've got lifelong relationships that I've met going to these conferences that are in our industry. And here's the thing, what I like about it, in a lot of the areas of real estate, you're out looking for a deal. If you find a deal, you find a distressed seller or a don't want, or that's a deal, and you buy that deal, and you probably never see or talk to that person again. In our space, when you make a connection with somebody, say somebody that's larger than you in the space, they can become a source, forever. You keep going back.
Sure.
They always have product, and likewise, there's people we always sell to. So I like not having to go out and find the next deal. It's more like my acquisitions director contacts the dozen or so people that we do regular business with and says, "Hey, have you got anything on your books that you want to sell?" Well, we're getting ready to buy this big pool and we don't quite have enough capital to take the whole thing down. Why don't you guys come in with some of your capital and we'll split them up? And I mean, we do stuff like this all the time. And so again, it's very relational. And what you don't want to do is be a yo-yo in this business and burn people. You want to do what you say you're going to do and, operate with integrity. So.
Yeah. And again, I mean, and from a business perspective, it's the lifetime of the client, the acquisition cost, the recurring cost. And so that's another conversation, but yeah. Let me ask you this, and I'll ask you to pull out your crystal ball here. 2021, what are you thinking is going to happen with interest rates? Where do you see things going in the next year from your Monument, Colorado window perspective of life?
Yeah, man, that's probably a question that would be great if my business partner were on the call, because he's a bit of a hobbyist economist, but he's super smart with this stuff. But so I talked to him and asked him, but I think we're in a low interest rate environment for quite some time. I don't see interest rates getting, I mean, they might adjust upward some, but I mean, come on, we're in the mid twos now for a 30-year mortgage so that has obviously created a lot of potential buyers out there. I think some of them still don't know that, still on the sideline. I think the market's I think hard assets, I think real estate, is where people want to be. So they're going to buy property, they're going to buy stocks, they're going to invest in our alternative investments. So, you don't want to invest in debt on the retail side. You don't want to be, you don't want to buy bonds when the yields are as low as they are, when you can put that money to work in equities or real estate. So now when I say, buying distressed debt is a different deal. And so the stuff we're buying is, like I said, institutions wouldn't touch it, but I think 2021 and beyond looks really good. I'm super bullish. I think we have steady, appreciation. I know that cap rates have gotten crunched down to the bone, like in the multifamily space, but again, people have to put their money somewhere. So, I think there's still plenty of play there. So.
Yeah, I agree. And I think that I think there's going to be I think like anything, there's going to be some people that get crushed. And I think there's some people that have a lot of opportunity, depending on, how you've run your business up until this point and how you see the market. Do you see any opportunities that are, whether it's in note buying or anything, do you see any blatant opportunities in your mind that you're thinking that's something I'm going to watch in the next, 12 months?
Like I said, I think in the commercial world, there's going to be some highly specialized opportunities with some of the repositioning. I do believe that you touched on it, Steve. I think there's going to be, I think there are, and will continue to be some great opportunities to become a landlord, to acquire rental properties in these markets where they're actually pretty attractive for people to move to. I think that's always been a good opportunity, but I think it's kind of exaggerated now. Look, you can buy single family properties, and even as an investor, get significantly lower than historical interest rates on your money. So you can get a 30-year fixed mortgage and then put a renter in there, and rents are only going to go up as we do hit some level of inflation that'll drive rents up. And you'll be sitting on fixed money. So right now, I think the opportunity is get as much of this low interest fixed money as you can, as long as the underlying asset makes sense, and cash flows. But I think there are going to be people moving out of the cities because of some of the drama that we've seen. And I think we're in for some more drama for the next few months here in the cities.
Yeah.
But I think people are just like, okay, that was kind of fun. We all did the urban thing, and, it's kind of cool, but, I want to have a family now. And, Tulsa's not looking too bad,
Yeah.
nor is Monument, or, I could name 15 other markets. So I think that is an opportunity. It's a long-term growing opportunity, frankly, to be in that end of the business. So
yeah, I think you're going to see a lot of secondary and tertiary markets really see the benefit of the upswing of this whole pandemic, working from home, people not having to live in the city. I think you're going to see that flood of that, and I think the cities themselves are going to see the anemic money revenue creep out of it. They're still going to have the businesses there. And then eventually the businesses may say, why are we paying these high costs of, California or whatever, when we can go relocate too in this virtual world? So I think you're going to see a lot of these overpriced markets really kind of, that pendulum, I think, is going to swing back. That's my opinion for what it's worth. I mean, I could be way off.
No, you're right. And honestly, if the political landscape changes significantly, here's the bottom line. I'm a business owner. We've employed 6 people. We're put it in perspective. Like I said, we're a 25-person company, and we've added 6 new jobs in our little business, and they're high-paying jobs since COVID began. Okay, so if businesses are disincentivized to remain in a location, they're going to go where business is welcome, where the tax structure, where people can see past this, the rich are getting richer. No, honestly, the wealthy people and successful people create jobs. They create economy. And at the end of the day, everybody wants to work, and everybody wants to be able to raise their family in an environment where the tax structure isn't, sucking the last dime out of their pocket. So again, I think the more, honestly, the more fiscally conservative, business friendly areas are really going to be attractive. And, you mentioned that, let's say the company in Silicon Valley, that suddenly their people don't have to come to an office, and so their people can work remotely. And you mentioned, the revenues continue, the paychecks keep going to the people. Well, they actually over time can afford to pay people less.
Yeah.
So they're sitting there in Silicon Valley saying, well, this is where all of our, VC and angel money is, but goodness gracious, why does my operation have to be sitting in, in San Jose? I don't need it to be there. I can, have a bunch of really happy people working in the office in Tulsa, or working from their homes. They're happy, we're happy. And now I'm not subject to California's crazy taxation and business unfriendliness. So sorry for you California listeners. I lived in California for 27 years and I love it. I think it's a great state. But honestly, I mean, there's some people that seem to be pretty intent on killing it for business. So
yeah, I don't get it, but again, they don't call me and ask me, so I don't know.
Yeah, I'm not in charge of that. So
yeah,
I can vote Jim, with my feet.
Yeah, exactly. Well, Jim, thank you so much for coming on today. I really appreciate it. I think note buying is such an interesting model, and I've been looking at what Aspen Fund does, and I mean, definitely you guys are, looks like you're blazing the trail there. If somebody wanted to talk to you, more about Aspen Fund and being involved, or just talking to you, how would they get a hold of you?
Yeah, best thing would be to just visit our website, which is aspenfunds.us. One word, ASPENFUNDS.US. and just just ping us and say, hey, I'd like to talk with Jim, or I'd like some more information on XYZ. Not soliciting investors here. We do have funds where we raise money from accredited investors, but really it would be more of an issue of, if somebody wants to get involved in note investing or doing it themselves, I can point you to some, like I said, some trainers, some conferences, some online materials, and we'll help you out in any way that we can. So that's the best thing to do right there.
All right. Well, Jim, again, thank you so much for your time. I learned a little bit about funds and notes and everything, so that was interesting for me. So I do thank you for your time. And for those of you watching, again, Mynd Property Management. If you're looking for any of your property management needs, Mynd is in over 19 markets nationwide. I believe we may be in 21 now, most investable markets in the country. So again, to me, it's all about having that team and that strategy. We talked about living remote, working remote, investing remote is the same thing. So having that team in place, being able to invest, you don't have to invest where you live, you invest where your money is best utilized. And that's about having the team on your side. So if you'd like to know more, you can go to our website at mynd.co. Again, it's MYND.co. And again, we're back every week. We have guests just like Jim and other rock star people to kind of fill our brains with information. And again, as investors, this is what we should be doing, educating ourselves, learning, and then go and explore and see if it's something for us. So again, on behalf of Jim, myself, Aspen Funds, and Mynd Property Management, I want to thank everyone for watching. We will be back next week with a whole new episode, and we will talk to you then. Bye-bye.